Angelo, as we get ready for Oracle earnings, what's the key headline that you're looking to hear from management?
Well, I think there's been so much noise throughout, between the last earnings season that it's going to be more about the narrative that the company sells here. I don't really think the numbers really matter here this quarter. I mean, the top line we expect to accelerate a bit, grow about 16%. The guidance is also going to be important. We're looking for growth of about 17 to 18% in terms of revenue growth. And by the end of the fiscal year, which ends in about May, we do expect the revenue growth rate to grow north of 20%. But what's going to be most important is the narrative they tell about concerns tied to debt financing right now, which has been in the markets here. The customer concentration risk, which has been clearly tied to OpenAI. They've got about they're gonna announce about 500 billion in bookings here this quarter. About 300 billion or so of that is tied to OpenAI. So that narrative they tell about debt financing, concentration risk, that's what everybody's going to be looking at.
I want to talk about that 300 billion because their credit default swaps, the spreads have moved higher. You've suggested that this was more AI hedging distortion than a fundamental issue. Yet Oracle reported 488 billion in RPOs, their obligations, with estimates that 300 billion tied to OpenAI. Break down how much of the RPO is realistically monetizable in the near and medium term, and what portion is contractually firm versus contingent on deployment schedules or infrastructure ramp timing?
Yeah, I mean, those are all great questions. And I would say the issue we're having maybe at this point with Oracle is, the 500 billion plus in bookings here through the end of the decade. Essentially, that's like a hockey stick type of inflection in terms of their infrastructure business. We're looking at basically a 9x increase in terms of the run rate between now and the end of the decade, and that's going to be progressively here over the next couple of years. It's going to be more pronounced as we go towards the out years of our forecast. Let's call it beyond fiscal 27 to fiscal 30, because that's going to be when OpenAI really starts to ramp up. So you kind of look here over the next couple of quarters, there shouldn't necessarily be any concern about the demand trajectory here of the company. Not to mention, when they do announce the 500 billion plus that we expect here on the earnings call, they've added north of 65 billion here over the last couple of months, and a lot of that is also going to go to Meta. So again, that's going to help potentially diversify here. But nonetheless, I mean, you kind of look here over the next couple of years, and there's definitely concern about that trajectory, but more in the out years, I think, than here over the next, let's call it 2 to 4 quarters.
Breakdown for someone who isn't as skilled in these numbers as you. We hear a lot of worry about OpenAI falling behind. Google, Gemini has now been declared the leader in many things. We've heard, all hands on deck call from Mr. Altman at OpenAI. What's the threat to Oracle if the worst case scenario is accurate for OpenAI?
Yeah, I mean, listen, I think, the commitments are what the commitments are that we've seen in the markets. I mean, essentially, OpenAI is chasing north of 30 gigawatts of capacity, and we're talking north of $1 trillion. And realistically, I don't think anybody believes that those commitments are going to be fully met, to be honest with you. I don't think there are any estimates in terms of the future numbers out there, but they are in Oracle's forward projections here. So it does matter, at least for Oracle, because the street has given that high hockey stick forecast and a $20 plus earnings forecast by the end of the decade. But to your point, listen, if the storyline changes to one where Google is a winner and OpenAI is a loser, that is a risk to Oracle, and Oracle is going to need to find a way to fill that potentially unused, untapped capacity that they're going to build here over the next couple of years.
I want to get back to the rising credit default swap margins and what that truly means about the financial health for Oracle. Is it just part of an AI-related market hedge, or how much should I worry and take seriously these credit default swaps as an investor?
So I don't think you need to worry. And the reason I say that is that the company is generating some very good cash. They're generating, cash flow from operations, let's call it $25 to $30 billion this year. And that'll continue to rise here over the next couple of years. They've issued some debt here recently. They're going to have north of $100 billion, in gross debt. Let's call it right now. They've got about $80 billion in net debt. So our bigger concern is what that means to valuation as the debt continues to grow and the margins also get pressured, at least at the gross margin side of things, because a lot of the initial CapEx build is going to be, is not going to be gross margin positive in nature, at least over the next, let's call it 12 to 18 months. So, but when you think about the debt increases, I don't think there's an issue, but the free cash flow here also for the company, we think is going to be negative for the next, let's call it 3 fiscal years. So there's going to be a net cash outflow. Whereas, listen, they're trading at valuations comparable to a company like Microsoft at this point in time. So the question is, which company would you rather own on the infrastructure side? And our view has been, listen, play it in a safer way with Microsoft. And if you want to somehow have an OpenAI hedge, you can also throw in an AMD or something in there.
So let's talk about financing, because their CapEx trajectory, how much of it will ultimately need debt financing? What are your current expectations for annual CapEx and the financing mix over the next 2 to 3 years?
So CapEx right now we're looking at is going to be about $35 billion this year. Again, they're going to generate about 25 to 30 billion in, let's call it, cash flow from our operations. So let's say the net outflow this year is probably going to be, let's call it, about $10 billion or so. As we go towards the end of this decade, our view is the free cash, the CapEx will probably get north of 80 billion, $85 billion, potentially north of 90 billion, depending on, what type of commitments are actually met, and actually, what the demand trajectory looks like. But the CapEx number is going to inflect significantly higher because the expected revenue is supposedly going to go higher. Again, that free cash flow will, we think, stay negative here over the next 2 to 3 fiscal years before the revenue and the profitability gets to a point, right? That leverage gets to a point where you return to positive free cash flow. But over the next 2 to 3 fiscal years, I'd suspect at least $10 to $15 billion negative annual free cash flow.
And so what's the red flag for, positive free cash flow or negative free cash flow sustainability or their credit quality?
I think on this call, what's going to be important, again, is the narrative that they tell about all of this, right? You've also got 2 new CEOs entering the mix. This will be the first call. And again, it'll be extremely important how they explain this. But if they can come out there and say, hey, listen, we've raised X amount of debt in the markets right now. We have X amount of cash from operations, and at least over the next 18 to 24 months, we're not going to need to tap the debt markets or the capital markets. I think that ends up being a positive reaction to the shares, and then they potentially have to again tap the markets at some point in the future. But I think that's enough at this point in time, given how much negative sentiment you've got in the shares, to at least kind of stabilize this thing and potentially get it a little bit higher.